Okay, thank you. Okay, welcome back. Now we're going to discuss infrastructure investing. Moderating this session is Paul Pachaka, a managing investment director for our investment office, and Paul's focus is on infrastructure and real assets. So please welcome Paul, and Paul, you will introduce your guests.
Thank you very much. Good morning. It's a pleasure to be here presenting and moderating this panel on infrastructure this morning to the investment committee. I'm actually joined by two of the most influential investment professionals in the industry, and importantly, two of the leaders of our strategic investment partners in our infrastructure program. On my left, direct left here, is Bayo Ogunlesi, who's the chair and managing partner of Global Infrastructure Partners. And on the far side of the table is Ross Israel, the global head of infrastructure for the Queensland Investment Corporation based in Australia. Both Ross and Bayo have law degrees and business degrees and have over 25 years of experience in this evolving and growing space that we've all been reading about and talking about for several years of infrastructure. Both their firms manage billions of dollars for clients just like us all over the world. Today in this session, we hope to cover three things. First will be a presentation by Bayo on Gatwick Airport. It could be followed by some Q&A from the investment committee. CalPERS is a 10% owner of the Gatwick Airport. We recently recapitalized our position this year in 2019. The second part of our presentation and discussion will be on the Port of Melbourne. Ross will present a case study on our investment that we made in November of 2016. Then the third and final part, I will moderate a discussion covering some questions that we have prepared to discuss with the investment committee. So with that, I will pass it over to Bayo to go over Gatwick Airport.
Thank you, Paul, and it's a pleasure.
Your microphone.
Okay. Can you hear me now? Okay. All right, let me try that again. Good morning. It's a pleasure to be with you, and thank you, Paul, for the invitation to speak about Gatwick Airport and also more generally about infrastructure investing. So Gatwick is an investment that we made initially in 2009, we being Global Infrastructure Partners and the Abu Dhabi Investment Authority. And then CalPERS, as Paul said, came in 2010. Now, we were fortunate when we bought Gatwick because it was a forced sale. Gatwick was owned by a company called BAA, which was also the owner of Heathrow Airport. And so the antitrust authorities in the UK told BAA that they had to sell Gatwick. Unfortunately for them, it was right in the aftermath of the 2008-2009 financial crisis. So they threw an auction, and we were the only people who showed up. And when you're the only person who shows up at an auction, you usually tend to buy things at a bargain. So we basically bought Gatwick for 80 cents on the dollar, and had we done nothing to it, it would have been a good investment. But what we saw about Gatwick were several things. One, it was an opportunity to own an airport in the most highly traveled aviation market in the world. London is, in fact, the busiest origin and destination traffic in the world. As you can see from this chart, London has two of London's airports are in the top 10 in Europe. It is one of two cities with that, London and Paris being the other. But if you add all the 5 airports that have London, they have about 150 million passengers. Paris has about 100, so it's easily 50% bigger. The second thing we liked about Gatwick was that it was a core asset. What do I mean by that? It was actually, at the time we bought it, it was a regulated airport. So basically, the regulators and ourselves and the airlines agreed on what charges we could charge, and therefore we were basically guaranteed a profit in the way we ran the airport. The third thing we liked about it was that it was a freehold asset. It was not a concession, so we ended up owning Gatwick Airport lock, stock, and barrel. We owned the runways, we owned all the facilities. Unlike airports in the US, where sometimes the airlines own the terminals, we owned everything. Fourth, we like the fact that the regulatory environment was very favorable. The UK actually has a very long history, dating back to Margaret Thatcher in the 1980s, where all the principal airports in the UK, with the exception of Manchester Airport, are also all privately owned. So the regulatory scheme was well known, it was quite favorable, and we're very happy with it. And then finally, we thought there were tremendous opportunities for growth, because the way that BAA ran Gatwick was the second largest airport in the UK. Heathrow, which was a competitor, was the largest airport, was they basically had all of the long haul, that's the long distance travel, funneled to Heathrow Airport and kept Gatwick for short haul traffic. So we thought there was a tremendous opportunity to actually reorient the airport and make it even more profitable. So Gatwick was and is a world-class airport, second largest airport in the UK, ninth largest in Europe. It actually has more routes, just under 240, as you can see on this chart, than Heathrow does. It serves 50 different airlines, and it's quite well diversified in that not one single airline or one route accounts for a significant portion of the traffic. What we also liked about Gatwick is the fact that it's the #1 low-cost carrier airport in the world. So when low-cost carrier, think Southwest Airlines, as compared to legacy carriers like United and American or Delta. If you look at airline traffic growth, low-cost carriers are actually the fastest growing segment of the airline population. So you want to be in an airport that serves passengers like this. As you can see, Gatwick's performance was very strong during the financial crisis. Traffic volumes went down a little bit, but they quite quickly recovered. But perhaps most interesting is the fact that in each year of the financial crisis, 08, 09, 09, 010, 10, 11, the actual EBITDA or profitability of the airport went up. And that's one of the things we like about airports. They have multiple levers you can pull to address financial performance. Think about a toll road. If you're on a toll road and oil goes up to $120 a barrel, people will stop driving. And there is nothing you can do. Cutting your tolls is not going to increase the amount of traffic, whereas with an airport, even if passenger volumes go down, there are things you can do to continue to drive traffic at the airport. In the 10 years we've owned Gatwick, we've been able to make very, very significant operational changes, which is one of the things we liked. So, for example, when we bought Gatwick Airport, Gatwick has only one runway. So it's not like San Francisco or LA that has multiple runways. And at the time we bought it, Gatwick was the busiest single runway commercial airport in the world. I am told that the only single runway airport that's busier is Bagram Air Force Base in Afghanistan, for understandable reasons. So a couple of our guys took a look at Gatwick, and they went to the management and says, well, look, right now we have 50 movements. That's a takeoff and landing an hour. We think we can go up to 55. And the management said, no, it can't be done. People come from all over the world to study Gatwick Airport. Well, today we're actually doing 55 movements, and we think we can get to 60. So if you think about what each movement is, so that's 3 hours in the morning where you have an extra flight. The passengers like it. The airlines like it because you're putting people on planes at a time when they want to travel. And each of those movements was worth £1 million of straight profit because there's no capex involved. 6 hours, 3 hours, peak hours in the morning, 3 peak hours in the afternoon. That's £30 million a year of incremental profit. When we sold Gatwick early on this year, we sold Gatwick at a 20 times multiple. That's £600 million of incremental profitability or incremental value created by making this change. The other thing we did at Gatwick was we looked at the security system. When we bought Gatwick, they were processing about 150 people an hour. Today, we process 600 people an hour through security. And we did it by doing a couple of things. I'm going to ask Mr. Henry, what do you think the most important determinant with how quickly people go through airports is? What do you think the most important determinant in how quickly people go through airport security is? Take a guess.
Time.
No, take a guess. Marcia.
Oh my gosh. Is it a trick question? I know.
No, it's not.
What's the #1 determinant
Yeah,
of people
quickly
going
people
through
go-
security?
yeah.
What people are looking for or what security is looking for?
No, you know what it is?
Can I
The
offer
size of the tray.
duty-free
The size of the
stores?
tray.
The size of the tray, right? Because the machine can only process so many trays a minute, okay?
Interesting.
So if it takes you 3 trays to put your stuff through, Takes you, what, 3 times as long. So if you go to Gatwick, you find these humongous trays, so you can put all of your stuff on one tray and move things quickly through. This is one of the things that these guys forget. I didn't know the answer, so I'm not, I'm not picking on people. I didn't know the answer either, okay?
But that still has an element of time.
Exactly, but you have to do it quickly, all right? And so you might ask, well, why is it important that you get people through security quickly? It's very simple. If people go through security and they're not stressed and they have time on their hands, what do you think they do? Exactly, they spend money. And so by getting people through, we're getting them to spend more money, which obviously increases the value of the airport. In fact, one of the other things that we're now doing at the airport is we're tracking spending patterns by origin and destination of flights. When you buy something in duty-free, they scan your boarding pass. Have you wondered what they do with that information? The answer is actually nothing, okay? So at one of our airports, we're now trying to see, are there spending patterns we can detect by where people are flying to? And so, for example, we found out that Scandinavians, for some reason, like to buy fortified wines. That's sherry and Madeira from Spain and Portugal. So every time a flight is going to Scandinavia from one of our airports, we change all the signs. We say fortified wines on sale, and the price, volumes go up, okay? So that's the kind of information we're trying to use to drive profitability at each of these airlines. So with all of these things that we've been able to do, obviously the financial results at Gatwick have been quite good. EBITDA has grown at a compound annual growth rate of about 12%. Passenger volumes are up about a third since we bought it. And of course, we've increased the EBITDA margin from roughly 30% when we bought Gatwick to the mid-50s today, and we think there's continuous room for improvement. Recently, CalPERS and ourselves agreed to sell a 50% interest in Gatwick to Vansi. Vansi is one of the biggest airport operators in the world. Vansi paid 8.4 times the initial investment that CalPERS and ourselves made. So this has been a very, very successful investment for CalPERS. And we will continue to manage it, and we think there's tremendous potential for growth going forward. So that's the Gatwick story, and happy to answer any questions people have. Now, Henry, you can ask me a hard question, okay? Since I picked on you.
In your view, what are the main risks the sector may face in terms of going forward?
Sure. For Gatwick, the biggest risk obviously is Brexit. I heard General Pretorius talk about Brexit. It seems like the Brits have shot themselves in the kneecap, and what we don't know is whether they're going to shoot themselves in the head with a hard Brexit. But our view is, exactly, our view is air passenger traffic is actually very, very resilient. So if a hard Brexit happens, traffic volumes will probably go down for some time, but they will quickly recover. And if you think about it, if there's a hard Brexit, sterling will go down, and so more people will want to visit the UK, and therefore drive passenger volumes up. So airports are really, really very good and resilient investments.
Can I ask a question? Sure. So, from Gatwick Airport, GIP has developed the expertise, kind of like a procedure manual of how to run the airport efficiently, just like what we see other managers. We have managers very good with software as a service. We have managers very good with the insurance company. So you become such a deep expertise on airports. Now back home in the United States, what's your view on our infrastructure need, and what's your view on the PPP, the public and private? Both parties now, if there's one agreement in the U.S. On Capitol Hill, across the aisle is on infrastructure, the need for infrastructure investment. So do you see any opportunities for people like you and the CalPERS?
Yeah, look, the U.S. infrastructure is interesting. You think about it in 3 different buckets. In energy, most of the infrastructure is already in private hands. The utilities are all publicly traded, with the exception of some utilities in California and some other states. The transport pipeline sector is all in private hands. Telecoms, that's all entirely private. The only real sectors in the U.S. that are in public hands are transport, so toll roads and airports. And the problem is the U.S. has had a history of really not encouraging private ownership of airports. If you go back in history, most airports were actually privately owned. And it was federal government policy which subsidized public airports that drove them into public hands, right? And so today we have our airports, which are pretty badly run, okay? But most states or municipalities' own airports have no intentions of selling them. And so I think until the states and municipalities have a financial crisis, it is unlikely that you'll see a lot of airport privatization. So the FAA has a privatization program for airports. They put so many restrictions on it that in the 30 years that this program has been in place, there have been only 2 done: Puerto Rico and Westchester County. That's the problem.
Ms. Yee?
Thank you, Henry. I was wondering if you give thought in terms of where airlines are going in the future, and with respect to particularly that industry being one of the highest emitters of greenhouse gas emissions. And so do you think about how the operations of an airport would change down the road, given particularly a transition to more low carbon fuels?
Sure. One of the things we actually have at Gatwick is a program to reduce our carbon footprint. And over the we've set a goal to reduce it by 50% by 2020. And we are probably 70% of the way there, and we think we'll get there by 2020, and we're going to sort of improve it as well. I think, there's some talk about electric aircraft. I think that's far off in the distance. Interestingly, planes are today much more efficient and much more environmentally friendly than they used to be. They use less fuel, they're much more efficient, they're much less noisy. So we think airports will continue to have a role and a place in the transportation sector going forward in the future, okay? What is interesting are the things that are changing are things like, driverless cars, or the advent of Uber and Lyft or people like that. Airports used to rely on parking for a lot of their revenues. Well, when people are taking Uber to the airport or taking Lyft to the airport, or heaven forbid, when driverless cars show up, all of that parking revenue is going to go away. So one of the things we keep looking at as we make investments in these sectors is what are the changes on the horizon that will affect how these things operate and how they are valued, and we sort of keep an eye on that.
Yeah, one other question. The Gatwick is in a developed market. What about emerging markets? Since this is such a high returning type of asset, can the risk be managed in emerging managers to embark on a similar type of transaction?
Certainly for airports and emerging markets, the risk can be managed, because at the end of the day, what does the people want from airports, right? They want high quality and efficient service, right? And if you're able to produce that and encourage airlines, one of the things we've done at Gatwick and the other airports we own is figuring out how to get airlines to fly into our destination. So for example, when we bought Gatwick, Emirates did not fly into Gatwick, it flew only into Heathrow. Today, Emirates flies 3 A380s into Gatwick every day. So we've figured out how to encourage airlines to come into the airports we operate. And of course, if you're in an emerging market, with a growing urbanization, growing middle class, what people want to do is travel, and if you figure out a way to get them efficiently from point A to point B, we think that's actually a very good investment to make.
So maybe with that, thank you very much. We'll hop the plane from Gatwick and go down to Melbourne, and Ross will take us through the Port of Melbourne. As I mentioned, CalPERS made an investment in that asset in November of 2016 with QIC.
So thank you, Paul, and thank you for the opportunity today to be with you, to talk a little bit about Port of Melbourne, and also to expand a little bit more on the infrastructure asset class. Port of Melbourne is a unique Australian asset. It's the largest container port in the country. It shifts 34% of our container trade volume, and as Paul indicated, it was sold by the Victorian government as part of an asset recycling program that's been initiated over many years in Australia between the federal government and the state government to incentivise, given our small capital base, a recycling of investment into infrastructure. And so it was sold in November of 2016. It was the largest transport transaction in Australian history until that point, and since as well. It is a significant landlord port, and maybe just to flush out some of the key attractions of the asset, it was sold as a 50-year concession A landlord port is a scarce commodity, and we'll talk a little bit probably about that in a moment. It was and is in a very strong competitive position within the Australian maritime set of assets that service the trade between Australia and the rest of the world. Thirdly, it has a very diversified and resilient trade base, which is a key aspect why it defines itself as a core piece of infrastructure. It also has a very attractive captive rental income, and similar to Gatwick Airport, as Bio was indicating, there's a diversity within the business of the Port of Melbourne which is very attractive and provides that resilience in terms of stable and predictable cash flows over time. It also has a very favourable regulatory regime, which is a key aspect which defines a number of elements and protects the asset on the downside with respect to returns. And then lastly, it has really attractive and significant growth opportunities with respect to the capacity that exists within the respective precinct of the port itself. So what I'd like to now do is just give you a little bit more colour on the nature of the trade and some of the characteristics within the port which really define it as a core piece of infrastructure, and expand a little bit more on the revenue model. Now, I know that Henry has been to Melbourne, and he can verify that you can see the Port of Melbourne from the central business district of the city. It is located in Victoria, which, for those of you that don't know, is the capital city of the state of Victoria. The state is a AAA rated state, and it also contributes about 24% of Australia's GDP. Melbourne is Australia's second largest city. It has a population of around 4.9 million people. By 2030-35, it will probably become Australia's largest city. It provides an essential service with respect to trade on the southeast coast of Australia, and is the principal put-off point for cargo between Tasmania and the mainland. In a port, a key factor is the hinterland that it accesses, and with respect to the Port of Melbourne, the hinterland crosses 4 of Australia's 8 states with respect to exposure. So again, a lot of diversified trade opportunity. And it also is in a highly good position with respect to competing ports. To give you some idea of distances, the 2 ports that would compete with Port of Melbourne lie in Adelaide and Sydney. In Adelaide, that's around 725 kilometres from Melbourne, and Sydney is 875 kilometres from Melbourne. To give you maybe a little bit more colour on 2 or 3 things here around what is the actual business of the port, what are the assets that it owns? The first primary asset that it owns is a significant amount of land, which Henry would have viewed as he toured the facility, and the rest of his team did as well as part of the diligence of the asset. 505 hectares of port-related land in stone's throw of the downtown of a 4.9 million person city is a significant investment opportunity. The second aspect of the asset pool is the port-related infrastructure, and this includes navigation channels, wharves, and what we call civil infrastructure. So this asset owns 7 kilometres of berths and 35 commercial berths for ships to come to port. And lastly, it also owns within its precinct a collection of portside rail and road infrastructure. These are all key to delivering goods through from ships into the logistic networks that service not only the City of Melbourne, but also the wider state of Victoria, South Australia and New South Wales. A little bit about the trade to give you a sense of what is entailed in a business like the Port of Melbourne. The trade is split between containers and non-containers. About 74% of Melbourne's trade is through containers, and this breaks itself down into 100 different product categories. So it gives you some idea, 2.9 million containers a year go through the asset. It then has a non-container trade, and this non-container trade includes motor vehicles, what we call dry bulk, which is cement, gypsum, cereal grains. It also ships break bulk, which includes iron, steel, timber, and it also ships liquid bulk, which is predominantly crude oil. And so the split here is also important with respect to imports and exports when you look at a port. And so here, again, there's great resilience in Port of Melbourne. The respective import percentage is 56% and the export percentage is 44%. in line with linkages with respect to this asset, where does those imports and exports come from? Predominantly China. So the imports come from China to the level of about 40%, and we export to China about 24% out of the Port of Melbourne. Interestingly, in terms of the US, which may be of interest to people in the room, we import through the Port of Melbourne from the US about 8% of the trade, and we export 6% of the trade to the US. I'd now like to sort of talk and expand a little bit on the regulatory regime and the positives that exist with respect to the landlord model, with respect to the Port of Melbourne. And the landlord model is important because it's very similar, and in the context of a landlord, similar to what you imagine in real estate. So you own 505 hectares of land, and you are able, through various compositions of tenants, to extract, if you like, revenues from that. The landlord port model is really a key port model or business model that's mainly been prominent in Australia and the United Kingdom. And it basically typifies by the fact that you have ownership and you have control of the majority of the port land and the essential port civil infrastructure within the context of a prefined site. The key aspect of the Port of Melbourne, which I indicated was an attraction, was the clear and transparent regulatory regime. And this is a key defining aspect when you look at infrastructure more broadly around a number of different sectors which are incorporated in the definition of infrastructure. The regulatory framework outlines how fees, prescribed tariffs, are set for the use of the port facilities and the assets. And what occurs in respect of that regulatory regime is it's overseen by an independent economic regulator. And those persons in the regulator oversee the prices that are charged and therefore protect the security and the competitiveness of the asset from a wider stakeholder perspective. The framework is based on a set of clear principles. It's designed to deliver an efficient cost recovery over the life of the relevant concession. And if we look at the nature on this chart of what are the prescribed tariffs, there are three areas in the port and how it earns its revenue that are, if you like, say, regulated. These are wharfage, berth hire, and what we call channel fees. The unprescribed tariffs are derived with respect to the real estate aspects and the property that exists and the users of that property within the precinct. And that's driven by market rental reviews, which creates a great diversity in terms of the cash flows that you can earn from the asset over time. And in particular, this asset's been very appropriately and cautiously presented to the market in terms of the privatisation with respect to ensuring that for the first 20 years, there's a CPI price link cap on the prescribed tariffs. And what that means is that there is a very much an alignment driven with respect to the users of the port and the key aspect of the facilities and the pricing that exists on the competitiveness of the product and trade that goes through the port. I'd now like to share with you an overview of the VIC terminal that Henry and the team would have seen actually at the port. And it's the newest terminal, and it's the most automated terminal in the respect of the port. And the reason it's really interesting is because it underpins the growth prospects of this asset. It currently moves about 2.9 million containers. Through the master plan that's been put together for this port and through a series of investments that were made over the 50-year concession, the optimised nature of this port will ultimately deliver nearly 12 million containers by the time we get to the end of the concession. That growth is a major asset for the business, and it also, with the resilience of the trade and the growth within both Melbourne and within the relevant hinterland, makes this a really highly attractive core infrastructure asset. And so with that, I'm going to cross my fingers, as one always does, and see if we can get this video to work for you, so you can get a sense
The
of it.
world's most advanced container terminal is open for business in Australia. Located at Webb Dock East in the Port of Melbourne, Victoria International Container Terminal sets a new global benchmark for innovation and port automation. VICT's state-of-the-art operation delivers a dramatic boost in trade capacity, supporting expansion of Australia's import and export markets. Our premier location outside the Westgate Bridge provides the first and only accessible container terminal into Melbourne for the next generation of larger vessels. But it's our innovative use of technology that makes VICT a global leader. We're the first terminal to integrate world-leading technologies into one seamless operation from ship to shore. Our fully automated in-gate makes it easy for trucks to enter and exit the terminal to maximise efficiency and save time. Drivers can drop off and pick up containers in a single visit. Automatic stacking cranes provide a smoother, safer interchange between trucks and container stacks. By integrating technologies, we've created a seamless experience for customers by truck or by ship. This means greater efficiency throughout your customer's supply chain.
There we go. Similar sunshine to what we are seeing here in Santa Rosa. So with that, I might close, Paul, and take questions or move to any other elements you wanted to cover.
Any questions from the board?
Okay, Ms. Yee?
Thank you, Henry. Thank you for the presentation. I wonder if you could speak about just some of the workforce transition issues with increased automation. And I'm more interested in kind of the roles and responsibilities given this landlord port model in terms of who really kind of has jurisdiction over those types of issues. And then if you could also speak to how you're dealing with air quality mitigation issues as well.
Sure, and that's a good question with respect to automation, because within the port, the respective container yards are sublet, and so there are 3 stevedoring operations within the Port of Melbourne. The one you saw on the video is the most automated of the 3, and the responsibility of that workforce transition is with those stevedore companies. What the port ownership is focused on and where we are centred is really around the safety of the site and ensuring that environmentally and the control of those sites protects workers, and trying to ensure there is a uniform quality around the nature of that workforce. The one that we have is only 100 people or thereabouts within the construct of the landlord model. This is where the landlord model is different to a concession model. The concession model, respective to a stevedore or a particular set of berths, would have the ownership of the issue that you're zeroing in on, which is this significant transition that's occurring within the logistics chain around the automation of container and also trade flows through ports. And so it is an area where obviously we want that transition to occur. We're working with the stevedore companies with respect to their challenges in moving through that automation. We're encouraging them with respect to training of those workforces, but our really primary focus is on the safety and the element of environmental oversight of the respective site, which then draws into your second question, which is around air quality and the respective aspects of this particular port. And it is a very important question because we are so close to the central business district. As you move from 2.9 million containers to 12 million containers, that's a lot of trucks that are going through the respective port, and we are right in the middle of the CBD. There are 2 things that I'd highlight which are really important in respect of dealing with that challenge. The first is one of the great virtuous aspects of the recycling model that occurred with the privatisation of the Port of Melbourne was the Victorian government set aside a large amount of money in a transport fund to optimise and improve the respective rail and road linkages into the port. And so in a very positive way, the 50-year master plan is dealing with that expected growth in respective trucks and traffic, and we are looking to have intermodal shift largely from trucks to facilitate onto rail a much less intrusive nature of that trade through the City of Melbourne. And so that's, I think, a really positive thing about the thoughtfulness that went into the privatisation and the heavy engagement that the asset needs to have with the state and with the regulator in order to ensure that in that growth it's done in a sustainable way. We are also minded and bonded by a series of environmental guidelines. The government still retains that right of regulation over environmental aspects of the operation of the port, and so we must comply with air quality. We are very focused on that, and also on sea level change and the nature of climate with respect to the respective asset and the dredging of the channel, to ensure that the appropriate ships that come, as they do get bigger, and we expect they will get bigger, are able to do so, and the channel is environmentally deepened over the relevant years to ensure that that happens in a sustainable way. So it's a very key focus of the business. There's been a lot of thoughtfulness put into the regulatory framework around how the asset operates, and we knew about all of those things up front when we acquired the asset, and I think that that clear and transparent regulatory regime is a very strong positive for ensuring there are no surprises, which is obviously, as a long-term investor, a key imperative for all of us.
Ramon, Mr. Rubalcaba.
Thank you, sir. Appreciate the. I want to follow up on Ms. G's question. I think I understand from the presentation and from your response that the revenue model has a lot to do how the automation was handled. I know in this port of Long Beach with the city of Los Angeles, there's to automate was approved by the Port Commission, but it was reversed recently by the City Council, the governing body for the city of Los Angeles. So how does the revenue model differ from what else happens, say, I don't know if it's traditional or for the city? Did you guys was there discussions with the stakeholders, with the unions there? I mean, what was different in this scenario and this model?
So there was an enormous amount of preparation by the government with respect to the site and the regulatory regime before it was privatised. And so these issues were systematically put forward, and they were addressed in the concession that we acquired the asset on. And so the obligations, the respective regulatory responsibilities have all been established up front, and the concession agreement binds the respective concessionaire, being the Port of Melbourne and the respective equity owners, around how they will run the asset. And so, if you like, the rules have all been established, stakeholders were all engaged with respect to their issues and concerns, and they were embedded in the respective concession and ensured that there was a long-term, clear and transparent mechanism by which issues around labour, the environment, the growth of the asset, the competing aspects of any other trades that are required within the respective precinct or hinterland to be dealt with, have all been pre-explored, pre-negotiated, and then established in a confirmed and transparent concession agreement that was put in for public disclosure and consent, and allowed, therefore, for bidders to explore due diligence and then obviously eventually own and take over the respective assets for a 50-year period.
Thank you. Thank you, Henry.
Ms. Taylor?
Yes, thank you. I had a couple of questions. So I'm going to draw on what Ms. G and Mr. Rubalcaba were talking about. In this transition to privatization and the automation, and I assume that one part of the port that's automated, that's your sample, your project plan, and then to move it forward. So you said there were specific obligations and regulatory rules, and you've said that several times, but I want to know, how are the workers, because it is our responsibility as investors to think about human capital, how are the workers being transitioned? Where are they being transitioned to if there used to be 1,000 at this particular part of the port and now there's 100? I think I heard you mention 100. What were the obligations for you? Were there obligations for education or working with the stevedores to make sure that they had someplace else to go? What were the obligations?
So I think it's important just to differentiate. There's 100 people working within the landlord port. Within the concessions that run the stevedoring operations, there's a separate workforce that is not part of the investment. They're separate, if you like, tenants of the port who have the responsibility for running the stevedoring operations of the respective container terminals.
So, and I will say, you know how that works is that the headline risk hits us as investors. So regardless of whether that's not really our responsibility, it kind of is.
So you're right, we deal with the respective interactions between labour and the ownership of those container terminals, and there is a very clear structure in Australia with respect to employee rights, and so we are, if you like, a middleman between those stevedores and the wider operation, obviously, of ensuring that trade continues to move through the port. And so there is a long history of mediation with respect to these respective transitions. This is a very clear and emerging space in maritime investment, though. What's occurred in that VIC terminal is probably going to emerge elsewhere around the world, and so we are really at the forefront of dealing with the sensitivities of retraining, the respective aspects of evolution that are occurring in the logistics chain, and so we are dealing with the sensitivities of the union movements within Australia, particularly the Maritime Union, with respect to how the stevedores operate with retraining. We're facilitating as best we can perspectives within other trades. So one of the key areas that we can do is we can drive more trade by extending the hinterland of the asset, which then allows the stevedores to have a greater perspective on the throughput of their facilities. And so for us, that is extending the hinterland of the Port of Melbourne further into New South Wales by improving rail links, which allow, if you like, the asset to grow further. And so while it's not our primary responsibility, we are very minded to inputting. We have a direct seat at the table with respect to disruption, and we are actively trying to grow the asset to ensure that the stevedores find over time a natural repositioning of the respective employees they have, because the automation that is emerging in this respective area of infrastructure is something that we're going to have to deal with over the next 10 to 15 years.
And I think that's what we're dealing with across the economy, and whether it's automation, gig economy. I think what's also not being addressed earlier was that we have a growth of populism across the world in westernized nations, and part of that problem has been automation, even though it's been blamed on immigration. I think that it's important as investors that we take account of that human capital issue that's constantly on our radar as we move forward and make these investments. I think they're wonderful investments. When you automate, of course, it you know, grows our investment. I think, and I wanted to ask a question. So we have longshoremen and truck drivers. What are stevedores?
Sorry, so that again.
What are stevedores?
Longshoremen. Yeah,
Okay,
just
I
another.
just want to make sure.
It's an Australian word for the same thing.
I figured. I just
Yeah,
wanted.
different dictionary of terms. I'm sorry.
Well, you don't speak English according to me. No, I'm just kidding. Just kidding. So I also wanted to. We've done really well this last quarter year with infrastructure. What should we, besides my concerns, but what should we be doing also to get more of these high quality deals that the two of you have been talking about, right? The airports, I get really excited when I see those on our reports, but I also know that it's something we can't, like you said, we can't invest in airports in the United States because they remain public. So how do we get into more high quality deals like these deals?
If I may just add something before Ross answers. So you're absolutely right, Ms. Taylor. Infrastructure has been one of our best performing asset class for a long time, very consistently. But the struggle we face is really how to scale this up to be meaningful. One of the challenges you will hear from me later today is a benchmark issue. So currently we don't have a benchmark for infrastructure. Infrastructure is benchmark against the U.S. core real estate. Back then that was the right decision, but that's a decision on the review as well.
Okay.
So back to your question, we are actively, Paul and I and the team, actively looking for ways to increase our investment in infrastructure. High quality, partner with the right partners such GIP and QIC. So these are definitely the the best of the best. And again, that speaks to our comparative advantage because of our brand and our size. We have access to brilliant minds in infrastructure.
Okay,
So
great.
I'll jump in here as well. This is an area that I took as a challenge when I started 4 years ago. We were investing, initially CalPERS' approach was to go through commingled funds, and then it drifted towards trying to be direct, which was a great move, but we were not able to scale. We were challenged, and perhaps Ross and Bio, we competed in essence with Ross's firm and Bio's firm from time to time, and they can maybe address that. But we have now morphed to one where we've recently closed on a separate account with QIC. We've recently closed on a separate account with GIP, in which we try to bridge the gap between having the ability to go direct and have strong governance and really focus on the selection of the assets we want so that they are good quality and we have the appropriate governance, while at the same time being competitive so that we can scale. So these are recent things that we've accomplished in the last fiscal year, actually in fiscal year 18-19, where we closed on a separate account with each of the respective firms. But if you will indulge me, Ms. Taylor, it actually was one of the questions I was going to ask, so I can maybe just hand it over and
Sure.
you can hear from your point of view, which is essentially how can we, a group like CalPERS, access the market, continue to grow the quality of our portfolio, and maintain the governance, if that's okay
That's
with you.
That's good, yeah.
Shall I start?
Go ahead.
Okay.
You spoke last, so you go ahead.
I think the answer to your question is you've got to be global, because the supply is from different geographies and different points of view going to be in fits and starts. And so, as Bio quite rightly pointed out, the energy sector in the US is deep, very deep with investment opportunities. On the transport side, it is far less so. To give you some idea, in the aviation space in Australia, 96% of the asset base in the country is privately owned. And so in the US, I think it's the inverse of that almost. And so by being global, you can access the relevant subsectors that incorporate the two key sectors that we feel you need to be exposed across, which is energy, gas, electric, water, in terms of transportation, airports, seaports, roads, rail. These areas require you to have a global perspective. And that global perspective gives you the aspect of your size to leverage position in large, high-quality assets. And those are really bounded with respect to geography and location. Those are the really high quality, the large population areas of the world are a good attractor for where the high quality, resilient infrastructure lies. There needs to be, in that definition of essential infrastructure, high barriers to entry, a strong degree of essential service in the asset. And so what you get with that global sphere is a wider element of supply opportunity, which allows you to leverage. In some countries, there won't be the relevant sophistication of operations. There won't be necessarily the regulatory sophistication in certain jurisdictions that will allow you to get really good relative returns. And so that global remit, something which in the size of CalPERS and which your wider investment experience provides you to do in infrastructure, is a really strong and big key meritable attractor for you, I think, in looking at it in that way. I think leveraging size and being minded to building a portfolio that is diversified is the other element that I think is a key aspect of success. Looking for uncorrelated return, diversification by geography, by regulatory regime, by sector, and one other really important diversification feature in infrastructure is life cycle, is age of asset. If you can infuse that in the portfolio as well, the resilience that you'll get in a global portfolio will be highly beneficial for the returns to your members.
Can I ask real quick? It just seems like Paul and maybe Ben, it's so crowded, and I've heard that from you guys, that it's hard for us to get in there at the scale we want to. So that's, I think we sort of answer to everything you just said, being global, leveraging size, portfolio is just diversified. Age of the assets, I'm not sure about that, but I think one of the things that we keep hearing from our staff is that it's hard to get in because it is crowded. We don't get in fast enough because as a public institution, we have a lot of rules we have to go by before we have the ability to purchase these assets. So how do we mitigate that? How do we get in there?
Yeah, so let's start with fundamentals, okay? Here's the good news about infrastructure investing. The secular and cyclical trends are terrific, okay? And why do I say that? The traditional model for infrastructure funding was the public sector provided most of the money, okay? Today, that model is broken and it cannot be fixed. So if you think about it, if you think about all the things that the public sector has to spend money on, healthcare, education, aging population, retirement spending, it's not a surprise that infrastructure spending actually falls to the bottom, okay? And if you combine that with the electoral cycle of most public officials, it doesn't measure up. If you want to build a new airport, it takes you 10 years to build it. Well, if you're mayor for 2 years or 4 years, you don't get the credit. Your successor does, okay? So that model is completely broken. And quite frankly, the only alternative, and this is why, people, remember when Vice President Biden came to New York and said New York airports were like third world airports? And all the New York politicians were annoyed. I think the people should be annoyed with the third world airports, okay? Because they are all better than the New York airports, right? So it's not a surprise that U.S. infrastructure, the American Society of Civil Engineers publishes a grading for U.S. infrastructure every 2 years. If your child or grandchild showed up with those kinds of grades, you'd ban them from watching television, take away their iPhone, take away their iPad, right? The best grade U.S. infrastructure got was D+. Okay? Everything else was worse than that, okay? So that model is broken, and so the only alternative is for private investment to come into infrastructure. So that's why I think the secular trends are good, and the fact that CalPERS is focusing on it is actually a good thing. Look, there'll be fits and starts. The US is slower than most other countries. Interesting statistic. Australia is 1/10 the size of the US economy. In the last 10 years, Australia has attracted more private capital into transport infrastructure than the US has, okay? That's Port of Melbourne, all the Australian airports are privatized, most of the toll roads are privatized. The US will eventually get there. It'll take us time, but we'll eventually get there. So I think there are tremendous secular trends that are actually very favorable, okay? That's the first thing. I agree with Ross. I think geographical diversification is a good thing. I think there are tremendous opportunities for infrastructure investing in energy. If you think about all of the shale gas and shale oil that's been discovered, we're going to have to spend $100, $200 billion just to get that shale gas from, the inconvenient locations it is in Oklahoma or wherever to market. That is all going to come from private capital. If you think about what's going on in the telecom sector with, 5G and everything else, tremendous amount of investments that need to be made in infrastructure. Again, lots of opportunities from that. One area where we keep looking for opportunities is, you look at a whole bunch of companies, right? Oil companies, transport companies, industrial companies. They all have infrastructure assets buried within their portfolios. So one of the things that we've been doing is approaching these companies and saying, look, you own this pipeline, you own this processing plant, you own these railroads. Why on earth do you need to own those things? Sell us and CalPERS, a 50% interest in it. If you want us to manage it, we'll manage it. If you want to manage it, you can keep managing it. And that allows the company to free up capital to go and reinvest in their core business, which is really what they want to do. So, I hear a lot about it's all very crowded in the infrastructure space. And yes, there's a lot of money that's going into infrastructure, but I still think there are tremendous opportunities. And I think what CalPERS is doing right is they're making a combination of fund investments with people like Ross and ourselves, but also having directed, separately managed accounts where Paul and his team says, look, I want to construct a portfolio that looks like this. Now you, Ross, you, Bio, GIP, go help me find those kinds of assets, okay? We hear a lot about pension funds and sovereign wealth funds who say they want to get direct investors. And so first question you ask is, well, how big is your team? How big is your team, Paul?
In infra, maybe 8 to 10 people.
Okay, so Paul has 10 people. We have 180 people. Now, I know Paul and his team are much smarter than we are. We don't think they're 18 times as smart as we are. So you leveraging us to help them find opportunities, I think is actually a good thing. And I think CalPERS has it exactly right in pursuing that strategy.
Yeah, and if I may add on a little bit to Ms. Taylor, you're absolutely right that the field is very crowded. But there are a few things we can do to chart our own path into the crowded space. One, as the panelists mentioned, is we can go up in size, where it become less crowded, less competitive. We can also go up in complexity. But as Abayo said, that our team is small. When we go up complexity, it's very critical to partner up with the right partners, such as QIC and GIP. And then the other thing, as you mentioned, that we should also increase our decision-making process, increase the efficiency or turnaround time of our decision-making without compromising diligence or prudence. But there are ways there are things we can do to address how crowded the space is. We can charter our own path, leverage off our brand and scale, and existing established relationship with the good managers.
Okay, Ms. Middleton?
I was very impressed with what I was seeing in Melbourne, but one of the issues that we know here in California is getting things to the port is just one issue. It's then getting them from the port through the urban centers and onto the distribution centers. So can you talk about your approach to integrating the ground transportation systems?
Sure, that's a good question, and one of the, again, thoughtful things that was set up when this asset was privatised was a fund which allowed some of the constraints within the Victorian network to be relieved, and I'll give you an example of 2 or 3 of those. So a large part of the proceeds the government got was put aside in a separate fund, which then began to ensure that all of the railroad crossings were reinforced for higher, larger number of trucks. And so the whole logistic network going into the port was improved by virtue of the sale, by allowing the existing assets in the road infrastructure to be improved. And they're assets not owned by the port, but are owned still by the government. So that was initiated. The second key thing that I think is really fundamental to your question is there's going to be an intermodal shift between road to rail, which is very key to us in Australia building what we call the inland rail network. This is a major federal project which is going to enhance the hinterland opportunity for the Port of Melbourne, but also what it does is it facilitates a large part of more efficiency for the existing trade to come by rail rather than road. Those 2 things are really fundamental. The third aspect is the development of some major arterial roads in the city to allow trucks to move out of the port in a more efficient manner so they don't go through city streets, so they enter the large ring road network in Melbourne, which then push the trucks to distribution centres, which are then on the fringes of the city and no longer necessarily in the centre of the city.
Is that public-private partnership or?
Yes, so the Inland Rail project is a public-private partnership. The advancement of toll roads are the arterial road developments. They will also be public-private partnerships. So again, not the obligation necessarily of the Port of Melbourne, but facilitated by the Port of Melbourne in terms of information and the flow of goods. But also the government has made the commitment to tender those projects, and they're in the process of doing so, which is very positive. I was just going to add one more point to the previous question and just say that one of the really positive things in the partnership model that Paul and Ben and the team are doing is that it drives a very strong focus in origination with partners like us, which helps us understand what is required in terms of CalPERS preferences, and the respective separate account model also, I think from a governance point of view, gives strong protection and control for issues that we were discussing around environment and social obligation that really are very important and helpful with respect to how CalPERS wants to be positioned as an investor and how, I suppose, appropriately the members would expect the capital be invested upon. So I think the private account model, the nature of the partnership approach, allows that sort of input to be significantly enhanced in the way you're advancing your infrastructure investment allocation.
Thank you. Ms. Brown?
Thank you, Mr. Jones. My question is for Ross, and it kind of goes back to the Port of Melbourne and automation, and it really piggybacks on Ms. Taylor's comments about workers being displaced by automation. And so as you were talking and she asked that question, I was Googling, and it talks about, find this story from July 11th about, they call them wharfies. 600 wharfies are battling to protect jobs and conditions at Australia's largest stevedore. So it looks like there's a 4-day strike that just happened, and just wondering how that strike disruption or disrupts our investments, and really what are we doing about those workers? Because I don't know that I got a good answer for that. I mean, I know automation is going to displace workers, but I think if CalPERS wants to do more of this type of investment, we need to know that there's a really good plan in place for that.
So the opportunities in the logistics chain are still significant, and so the evolution of the logistics businesses and freight forward businesses, which are not, let me just reinforce, are not businesses that sit within the Port of Melbourne as you own the asset. These are sitting in a tenant of the port, and so this is an obligation that's not sitting directly with us, but as you quite rightly point out, we are affected by the trade flow, any disruption that occurs with respect to the management of that workforce. And so through the union movement, there is a real life engagement about retraining the respective stevedore workforces to deal with automation, to get if you like, appraised of how the logistic chain can evolve. This is not going to happen overnight in the context of the respective container yard that are operated by 2 of the large stevedores in the Port of Melbourne. But what happens in the asset that we have is we have a large automated terminal which gives both of these stevedoring businesses a relative competitive threat over a longer period of time. And so the nature of engagement is around how are those workers being retrained, how are the union and labour forces assisting those particular workers deal with some of those challenges. Also, the age of the workforces is a factor, so there is a relevant tailing of the workforces. We have a very strong compulsory superannuation system in Australia, which provides a robust retirement base at 65 for any working person, and a respective employer has to contribute into that respective superannuation fund as part of the obligations to them. So the relevant labour unions are dealing with the entitlements and the benefits in combination with what are the operational timelines which are going to enforce themselves upon the operation of the port. And so while we're very, very engaged and we're very focused on the relevance of safety and workplace performance, the obligation doesn't exist directly with us, but we are looking to facilitate the appropriate conversations and be a mediator of sorts with respect to labour and the stevedoring companies that run those container yards, and hopefully with respect to growing trade, facilitating more optionality within the port and that land bank to allow them to expand their businesses, redeploy those respective people, maybe not necessarily moving containers off ships, but to be in the relevant logistics chain attached to how those goods move out of the port, is a relevant opportunity set for us as a landlord owner to help the stevedores in that inevitable tide that they're facing with respect to automation in their businesses.
Thank you.
Mr. Miller?
Thank you for your presentations. I want to kind of go a little bit more global, and this is for anyone who wants to jump in. I'm kind of curious, when you look at the potential for us as a long-term investor, looking out at less developed countries. And looking at kind of in the context of some of the things General Petraeus talked to us a little bit about, when we think about China as, you know, are they enemy, adversary, competitor, partner? And you look out in the world, and even 40 years ago or so, you saw them making very strategic moves to have a much bigger footprint in the economy and the marketplace in places like Indonesia. And now, especially when you look at Africa, and there's a lot of diversity of global risks there, but do you think for us as a long-term investor, there will be more potential for these kind of large-scale, to have a piece of some of these larger-scale infrastructure investments in places like that, whether it be airports, shipping, energy, cadmium, whatever? And how do you see that affecting your business, your industry, and the kind of partnerships we could have with you?
Sure. Emerging markets certainly create tremendous opportunities, okay? But they also come with tremendous risks. And so, and not a lot of money, not a lot of people have done very well investing in emerging market infrastructure. So I think the first thing you have to do is you've got to be careful about your country selection, okay? You have to be very careful about your industry and asset selection, okay? And then third, you have to be very careful about your partner selection. And finally, you have to be very careful about your team selection, okay? I think if you get all four of those things right, then there's a pretty good chance that you can actually be very successful investing in emerging markets. Because if you think about it, something like, I think the number is 70% of the total spending on infrastructure between now and 2030 is going to be in emerging markets. And that sort of makes sense, right? You got rising populations, you got growing economies, most of them growing much faster than developed markets. You know, China is growing at 6.2% and they're complaining, you know, right? We're barely getting 2% in the US. Europe is 1% or less. You have growing, a very strong growing middle class, which creates, you know, demand for infrastructure, whether it's in energy or in transport or in other areas. And so we think that's going to be an area of opportunity. We have invested in an infrastructure fund management business in India because we think the Indian government of the current time actually creates opportunities in a way that hasn't been done before. We think if you look at some of the fast-growing countries in Southeast Asia, if you look at some of the stronger performing countries in Latin America, those will all create tremendous opportunities for making good infrastructure investments. And one of the things that people often lose sight of is, you know, many multinationals, you know, whether if you think in the oil sector, whether it's the Exxons or the Chevrons or the Royal Dutch Shells or the Totals of the world, they have to operate in these countries, which is where, in fact, it turns out you find most of these commodities. And so, you know, if Exxon or Shell wants to build an LNG facility in Indonesia, CalPERS or somebody else partnering with them to build that, I think is something that makes sense. If Exxon wants to build a pipeline to bring their crude oil from offshore to onshore in Brazil so it can be exported, partnering with them to invest in those kinds of assets is an opportunity. So we are actually quite optimistic that if you do it right, you can find tremendous opportunities for very attractive returns investing in emerging markets.
I would just add to Bayo's list of 4 things. I think the structuring can be a little more challenging too, because you may be dealing with a new partner or a less experienced partner. How you structure your terms of trade with them and your revenue model is really another important factor that I would add.
Okay, so then no further questions. I would just like to also thank Ross for the invitation to come and tour Melbourne, because it was a group of trustees from all over the world was coming to try to capitalize on that market. And so I got the word that, hey, well, CalPERS is already an investor. Do you want more of this? So you better come. So we appreciate the heads up. Thank you. Okay, so that concludes this. Any other comments, Paul?
No,
Okay.
I'm fine. Thank you.
Okay. Okay, well, thank you, and let's give an applause for our panelists. Okay, I think we may be approaching lunchtime, Karen. Is that the clock says?
Yes, at this time, we are going to break for lunch. We're going to take a 1-hour lunch, and when we return at 12:45, we'll be talking about emerging manager programs. So enjoy your lunch, everyone, and we'll see you at 12:45.